Welcome to the Gray Report. If you're a multifamily investor, active, passive, you're in the industry, luckily for you, you're in the right spots. Every single week on the Gray Report, we are looking at all the latest news articles, data, any information that's coming out involving the multifamily industry, housing market, commercial real estate, and the macro economy to help us make some really well-informed decisions. Dr. Matt Bossong, he's got a great slate, an agenda of articles to discuss today. First one from Moody's Analytics, Groundhog Day. Well, it certainly has felt like Groundhog Day in commercial real estate. Interest rates up 1 week, 3 weeks later, they're down, or the anticipation of the rates going down changes all the time. And our sellers and buyers going to actually meet to allow for transactions to start happening at volume. We'll see. I feel like we have this conversation every week, but maybe we've got a little bit of progress. And then from BlackRock, not Blackstone, a piece on their private markets outlook where they mention specifically multifamily and commercial real estate. And then the long anticipated report from Marcus and Millichap, their U.S. multifamily investment forecast. Again, every year they put this out. We're going to be digging into it and seeing what insights that we can pull apart. Then from RealPage, there are 7 takeaways from the NMHC's annual meeting. We touched on some of the takeaways last week, our own takeaways. We're going to get RealPage's opinion as well. And then finally, from Harvard's Joint Center for Housing Studies, estimating the national housing shortage. There's different estimates out there. We know we have a housing crisis, but how deep is the crisis? We're building a lot of units right now also. So are we making progress to try to kind of fill this gap? Well, we'll take a more or less non-biased look from Harvard's JCHS, try to get some answers. All right, strap in. This is going to be a great show. Bring in Dr. Matt Bossnoggle in again, just to help keep us straight. Let's get into it. All right, back in the report, Dr. Matt Bossnoggle joining us once again, as is every week. Director of Communications and Marketing at Gray Capital, as well as the producer of the Gray Report and the guy who puts together the Gray Report newsletter, which if you're not signed up for the newsletter and you like this stuff, if you like staying up to date with the multifamily industry, graycapitalllc.com/newsletter. You get the bi-weekly newsletter, all these articles, and a lot more. Never miss a beat. Matt, how you doing today?
Pretty great. You mentioned Groundhog Day, and I had to go and look it up. So the Punxsutawney Phil,
what's the skinny?
Punxsutawney Phil, which is that he's the official. A lot of towns have their own groundhogs. I listened to Phil, and Phil saw his shadow. Wait, did he see? No, he did not see his shadow. So
okay,
what
does that mean?
If the groundhog does not see his shadow, that means spring's coming early. And so, and that actually applies to every facet of life. So that means that along with weather improving, the CRE markets are going to improve, interest rates are going to improve, the economy is going to improve, everything's going to thaw, spring's going to come, everyone's going to be happier, it's going to be warmer and comfortable and happy. It's going to be nice.
You know, with an absence and a vacuum of actual good indicators to look at, Matt. I don't think that's
right.
I don't think you go wrong, right? What else are you going to look at?
Well, I mean, what did
Jerome Powell are changing?
Yeah, Jerome Powell said, "What we're like in the middle of the night and navigating by the stars." No. I'm
going. Yeah, we navigate by the stars under cloudy skies. Exactly. Yeah, the stars are there. We just can't see them.
Going with Phil. Phil doesn't need cloudy skies or stars. He needs a shadow. He didn't see it, and now we're going to be good.
And so, is the shadow? Is it just weather depending on like, are there clouds?
If there's clouds, then maybe he can't see it, or I do not know, because you'd think if it was sunnier.
And we'll get off the groundhog thing in a segment. But are you saying there's other towns that have their own groundhogs?
Oh yeah, there's a bunch of different groundhogs. There's one. I think one town has like an albino groundhog, which is nice, but that's no Phil.
There's a lot. Is it the same groundhog?
No. They don't ship it around. He visits. It's like Santa. He visits every place in one night. I don't
know if there's like a lineage or anything. Anyway, so fascinating stuff, Matt. We've been all over the place. Last week we were in San Diego. This week we were down in Southern Indiana doing some due diligence on a property, getting ready for an acquisition. Been having a lot of conversations with investors, with brokers, talking about the market. And I think it does make sense that there could be some thawing because there's an anticipation that maybe we're not at the bottom, but maybe we're very close to the bottom. Yeah. And the investment sentiment out there is so strong. There's so much equity and willingness to get into the market and to buy. It seems like it'd be difficult for prices to go so low
Yeah.
because there's a floor and there are bids out there. Just the bids, most of the bids are a little bit below the current ask, but that ask is getting much closer to those bids. And if interest rates come down a little bit, maybe the bids can come up and people are gonna be antsy to do some deals.
Yeah.
So I could see some thawing.
Well, I think that
All right.
one Well, I think that one factor could be, yes, interest rates is going to make it easier for the buyers, but I don't know how much realization has to set in on the seller side to come down, or if it's all going to be ameliorated by the buyers, and that's going to bring them more activity. Because if rates get cut even 2-3 times, that's still not going to bring the rates down to where they thought rates would be in 2022 or something. Like, that's not the environment that buyers want. Buyers want the environment of 2022, and 2023 or 2024 it's going to be a little bit better, but I still think there's got to be some adjustment on the seller side. And I don't, yeah.
There definitely has to be some adjustment on the seller side. And again, as we've talked about, some folks are just going to kick the can down the road if they can because their lenders will allow them to extend or they've got term left on their loans. And, why sell in a
Yeah.
market that you're not going to get your price if you can't hold on? All right. Well, let's look at this Moody's piece, Matt, getting
Hmm.
more into the Groundhog Day, even though it was last week, right? But will there be a long winter for CRE? We've already answered it, but let's look at some of their highlights from what Moody's Analytics is saying. The
Yeah.
first point, Matt, then I'll just hand it over to you.
Hmm.
They're in alignment with your projection of around 2.5% rent growth for 2024. What are some other highlights that stood out to you in this piece from Moody's?
They along with everyone else has talked about how the office sector is in trouble. Retail was actually surprisingly resilient, I think, in the past few years, and they're still noting that they're similarly resilient. And what is interesting though is for like warehouse distribution, I think I would lump maybe this in with logistics. Those properties are expected to have rent growth in the mid to high 4% range in 2024. And
Mm,
that's even after, the killer years that they've had for the past like 4 years. So
yeah,
they're really that's a huge winner of maybe they won the pandemic. I'm not really sure exactly, but it's really interesting to see how much continued effort is in this. I'm sorry, building development interest really is in this sector, and I don't think that reshoring is going away. It seems like so much has gotten started and keeps going that it's hard to see this as a wave and more as a really like fundamental reorienting of of how manufacturing and shipping is
yeah,
going to look.
very secular trend in general. I think the
Yeah.
reshoring is one, but then also, e-commerce is not done growing, and those
Mhm.
logistics, those supply chains, yeah, really not done. I mean, Amazon kind of put a pause on a lot of their development a year and a half ago, maybe 2 years ago. But
Mhm.
from what I've heard, sources that are inside the industrial world, they're back at it. They're building again. They're trying to get sites moving to keep kind of filling in these gaps in their supply chain. So
Yeah.
yeah, I think that there's a long runway for industrial to keep going. Certainly you can oversupply and overbuild, but I think most likely, the interest rate environment, similarly how it's cast some cold water on housing development, multifamily development. There's probably slow down industrial as well, and we still
Yeah.
need those warehouses to move things around, especially if they're going to be building more things and manufacturing more things in the United States. On the multifamily side, Matt, it looks like they're really pointing towards a topic that we've discussed at length and just looking at it a little bit differently and just from another source.
Mhm.
Um, Really with this idea of that, rebound and growth is expected to be constrained by continued solid completions. Now, we talked about last week that there's a disagreement on how many units will actually be completed and delivered over the next couple of years and when that will happen. We're going to look at the piece later on from Harvard talking about, how many units do we actually need? But one thing that we can be confident about is that there's a lot of demand for multifamily, a lot of demand for apartments right now with interest rates being high, but there is so much new supply coming online. When looking at a national level, a national perspective, 'cause it's really tamping down any kind of future growth. And in fact, if we weren't seeing strong demand, we would most likely see further negative growth because we haven't delivered as many apartments like we are today in the last 36 to 40 years. So it's really incredible. And you've mentioned this multiple times, just how resilient the multifamily market has been in spite of all the new product that's coming
Yeah.
online.
Even though their numbers here look like they are half the size of all the other estimates for
Yeah.
completions, and they're following a different trend than I thought. So 2023, for every other source that I've read, had record amounts of completions, and for this, 2023's numbers are lower than 21 or 22. So I'm not really sure where they're getting their completion numbers, but still they have a rent growth figure that's in the low to mid 2% range, which agrees with my hot take. And I'm going to add that alongside the Marcus and Millichap forecast. To we've got a collection that is hovering around 1.5% to 2% rent growth for if you kind of aggregate all of these. And I think that's a pretty strong. Those are pretty strong numbers, and maybe could outperform 2023. Um,
Yeah,
the
there could be a surprise.
Yeah, yeah. I think that a lot of people are getting ready for another year of focus on operations, efficiency, making sure that expenses are under control. I think that the problems when the expense side are going to be slightly less strident and or existential, I guess you could say, and the upside maybe it'd be a little bit of a surprise. Maybe we'll have a little bit more breathing room for operations and for kind of making sure that investors' returns are on the up and up when it comes to rent growth. But that's
Yeah,
there's a lot of
I think
unknowns.
that,
But
that makes sense.
and
Well, and also, again, it has to be, mentioned, Matt, is when we're looking at national projections and national figures, it really doesn't tell the whole story because
yeah,
most likely we're going to see some markets outperform and other markets
yeah,
that are going to underperform. And the biggest reason for that is just the main variable. Demand's in there also, but the main variable is simply just how many units are you delivering that year.
yeah,
And if you're
yeah.
delivering way too many units, you're going to have weaker negative rent growth. There's just so much competition. These units come online and they're just fighting tooth and nail to get as many units leased up as soon as possible because they've got this
Hmm.
carrying cost that they're having to pay for.
Yeah.
And every month, Matt, that a unit, that a property isn't leased up and they can't sell it, if you're a merchant developer, you're building to release and then
Mm.
sell, your IRR is degrading every single month you don't sell. Every month you don't lease up, you're losing IRR because it's a time-based metric. And a lot of these, partnerships, they're built on IRR-based waterfalls and where
Yeah.
the splits don't get really good for the developer unless they meet certain hurdles. And it may be a successful project, but if you tack on a year to that project, that the IRR can be significantly less. Even if the equity multiple may be similar, that equity multiple may
Yeah.
be even better. But the fact is that if you can't cross those IRR thresholds, it's real dollars to a promoter. And so the incentive is not necessarily do I hit all of my rent pro formas, but can I get it leased up and stabilized so I can sell it or put permanent financing on it and not have to pay the high construction loans, which are kind of in the 8 to 9% range.
Hmm.
Steep.
Yeah.
Anything
I
else, Matt, on the or go ahead.
I
Anything else
I
on the
I
Moody's
kind of
piece
just
that
wanted to
caught
know
your eye?
in general, like, and this is all, this is kind of speaks to the Groundhog Day kind of. Are we repeating? Is this the Groundhog Day movie, or is this Groundhog Day? We're going to see
Mm,
spring and the other time, and I think that we're moving a little bit away from the movie where everything's the same and nothing changed. Where you're waking up and you're playing the same thing over and that was
yeah,
2023. I think that we are. I
I
think
think we're escaping it.
I think that we're escaping it. I think that what is hopefully will allow people to escape it is that we have more data. We have a lot clearer picture than we did in 2023 when it comes to the economy. And this is what I wrote in the newsletter, so that's why I'm kind of champing at the bit here.
Mm,
But when it comes to the economy, interest rates, apartment construction, and even arguably investor activity, we've got a better idea. People are saying, "Oh yeah, I'm gonna buy more in the second half of 2023 or 2024. Last year they didn't say that. They were more uncertain. They were more uncertain about the economy. Uncertainty prevailed at the beginning of 2023, and I think that the clarity is going to allow people to make bets, to make investments, to understand where the risks are, and where they're going to buy and where they're not going to buy, and so that hopefully will lead to more activity. But
I think that there's a little bit of like boy who cried wolf scenario and it's the economists and the macroeconomic and industry um, folks who have said multiple times that hey, we're going to see recession. We're going to see recession at the end of
mhm,
2023. We're going to see recession the first quarter of 2024. The recession, it's the boy who cried recession, and they've heard it so many times, it just hasn't happened. And the economy is just crushing it, and it continues to crush it by many metrics. Not that there aren't worry signs out there, consumer debt, and other things, but in looking at unemployment, GDP growth, the fact that the housing market hasn't crashed, it hasn't crumbled, and things are looking pretty good. We've got a really good economy by most metrics. People all of a sudden are starting to say, I'm going to ignore a lot of these warning signs because I need to make some moves. I want to make some money and I want to get out of being in bonds and my money market because I'm going to be left behind. I don't think people
mhm,
want to be left behind because if you were out of the stock market last year, you kind of were left behind if
yeah,
you were sitting out. A lot of people were for good reason. Everyone was said that the world economy is getting ready to crash. So it's
mhm,
not like it was a bad reason you were on the sidelines. But just from an anecdotal perspective, Matt, I've got a lot of anecdotal data points on this, not just my own conversations with investors, but in my conversations with investors and others, people are ready to get back into the market. They're looking for deals. They haven't done a deal for a long time. I don't know how many people
well,
said, I haven't done a
and
deal for a year and a half.
that's what I wanted to ask you. And I know, we are pursuing a deal, and we can edit this out if this is inappropriate. But I won't give any specifics. But I would like to know if you can tell me what what the attitude of investors when you're talking to them and kind of saying, "Hey, we've got something going. I just trying to gauge your interests." Are they like, "I don't know now," or are they like, "Yeah, get me in"?
Yeah, no, I can tell you. I mean, the contrast could not be more stark
Yeah.
now compared to like 6 months ago. Six
Wow.
months ago, having conversations with investors who like us, want to do deals. They'd say, "Hey, we like you guys. We want to do a deal." But right now, it's just tough. I'd really like to get, a little bit more time, a little bit more clarity, and there's a lot of just worry cards out there. It looks rough, and the reality, and this was the case for us as well. It's like the returns don't make any sense. It's like I'm not
Mhm.
going to do a deal where the returns look bad and it's uncertain, and I'm going to pay a high price. And I think that those investors and the sponsors like us, I think we're correct in saying that not that we're out of the market, but these prices don't make sense right now. And we need the prices to come back into alignment. And we're ready to do a deal. As a lot of these investors are saying, they're like, I'd love to do a deal. I love real estate. I love multifamily, but it's got to make sense. There's uncertainty. So I need to get paid for that uncertainty if I'm going to
Mhm.
take the risk. And now there's still uncertainty, but there's more clarity than there was.
Yeah.
And I think there's more confidence and people just want to take some action. So, yeah, so from 6 months ago, almost everyone was saying, I mean, I'll send me a deal. I'll look at it. Happy to look at it. Right now, I'm not going to make any promises though. Things are they're confusing. I'm just not sure what I'm going to do to today. And so we haven't launched this deal yet, Matt. We haven't made an announcement
Yeah.
that, that's coming. I mean, by the time this gets released, we'll probably be under contract. You may have gotten an email from us. Um, but in conversations with our like existing investors, some of our anchor investors, just preliminary conversations, because obviously we need to have some things lined up before we actually kind of press go. We've only had one investor who has said no, and the only reason for that is just a market. It's just they need to be in a certain size of market
Mhm.
that looks a certain way, and because they're not local, they've been so far the only group that's passed, and then they've said like, let's we want to do your next deal. They want to do a deal in Indianapolis specifically, but every other investor we've had conversations with, and not all existing, just folks we've had conversations with, and almost all these people again 6 months ago said like, I want to hold off. We have gotten commitments from every single person we've had a conversation with so far. We've never had that rate of commitments.
Yeah.
And the speed of which we're receiving commitments
Oh
is
man.
surprising. We're getting yeses on the first call.
Yeah.
And they're saying, "Look, yeah, I've been waiting to do a deal with you guys. It's not just about us, but they're like, this deal looks good. This is what I've been looking for. I mean, it's a value add deal. And so as long as you're kind of open to doing a value add strategy, it's checked all your boxes." And frankly, people haven't even done. They're not even digging into it that deeply. And we're going
Yeah.
through the whole, the project. But they've done deals with us. They've
Yeah.
done deals with us in the past, so they've got, like, we know what you guys can do. Terms look good. The project makes sense. The story makes sense. Let's do it.
Yeah.
So we've never have had this type of response from a deal ever since we've had a deal. So again, it's anecdotes, only, a dozen or so investors. And we're going to be having a lot more conversations here very, very shortly. But so far, it's a really strong indication. And I've gotten other really strong indications just from just talking to other people in general that equity is coming back, and they're starting to ramp up, and they're looking to make some moves. Because again, you may have a lot of money in your money market account or in bonds, and you're looking at it and saying, okay, if interest rates are going to be coming down, those money market accounts, it's great
Yep.
now making 5.5%, but all of a sudden I'm not making that anymore, and all of a sudden I'm making 3.5%, 4%. I will have wished I would have done a deal that's throwing off 6% or so, and coupled with the idea that, okay, pricing has actually come down. Pricing is better.
Yeah.
Pricing is 15 to 30% lower than it was at the peak.
True.
Interest rates, haven't really come down, but the idea that they will come down, and this was what you were talking about earlier.
Mm-hmm.
If you get into the market after interest rates have come down, and it's like, let's say with the Fed funds rate or the treasuries, that they come in, and they start, all of a sudden deals start making sense. That point, the best deals will have already happened.
Yep.
Like the best deals are going to be from when the rates are still where they are today. And as rates come down, you're under contract and you close.
Mm-hmm.
But the deals today have to work. And so think about this. So like if the deals work today within a higher rate environment and they're good deals, good returns, make sense, then factor in rates actually coming down before you close. I mean, that's huge upside potentially, because you can get more potential more leverage if it's appropriate, and a lower rate, lower debt service. It's huge.
Yeah. Well,
it's like, like right now. Yeah, go ahead.
Well, no, it's just like you hear about everyone in all these sources that we'll talk about today and that we've talked about yesterday, or I'm sorry, last week. They all say, H2. Everyone's going to jump in H2. The CBRE survey of investment intentions, they said H2 2024. That's when they're going to start investing. Are you going to jump in when everyone else does? Because usually when investors compete, prices go up. So you're going to do it. Try before.
It's a great point. Yeah, everyone's got their calendar marked H2. And I think it's more going to be like third quarter, beginning of third quarter. I don't think it's going to be beginning of second quarter. I think it's end of second quarter, early. Who knows? That's my gut. Yeah, if everyone's getting in, then what's that going to do to prices? The prices are going to go up. The competition is going to go up, and then maybe the deals will still make sense. If the deals will still be good, but they're not going to be as good today. And then so if we're mapping H2 as the time period when there's a strong bid on multifamily, the trough has to be between then and now.
Yeah.
Right. And it could have already been. We could have passed the trough and low point in prices.
Yeah, like
and
I'm not the only one thinking
probably
that,
have.
Sure. Yeah. I
We're not the only
agree.
No, and we're going to talk about NMHC and the seven to everyone. It's but my only gripe with NMHC is that it's an echo chamber.
Yeah,
and it's an echo chamber that's driven by market participants who are trying to sell multifamily real estate. It's driven by the brokers, and it's driven by the lenders who are trying to do deals. And so obviously there's always a bias for things are going to be looking good in X, or things are looking good. Things will always look good. Of course there was like, well, it's been bad. But the consensus is like it's going to be really fine and good.
Yeah.
And we're going to have really good volumes because we need good volumes in order to stay in business.
Yeah.
Self-fulfilling. But it can be a self-fulfilling prophecy, right? I mean, if that's the sentiment, people do get in, the prices do go up.
Yeah, and I agree, and we can talk about that in a second when we cover the.
Let's go to this BlackRock piece.
All right, yeah. So,
Let's just jump into this BlackRock piece.
can you explain a little?
If
Because
I can,
I confuse BlackRock with
mhm,
Blackstone
yeah,
on a pretty
mm,
much on a daily basis.
yeah,
So what is the difference between the two? And I know they're different companies
yeah.
completely, but when it comes to focus of investments,
Well, they split off in the late '80s or early '90s.
okay,
Um, yeah, so very simply, BlackRock is a public securities asset manager. So stocks and bonds. Think of it like that. Stocks
okay,
and bonds. Blackstone buys private assets, like
okay,
alternative investments. So like real estate. Like they're the
got it.
ones that are in the real estate private equity space that are buying up the apartments.
Okay,
BlackRock, they may invest in like some REITs. They may invest in public company in the housing market. But they're looking at all different types of public securities that are out there.
okay. So that's
And I'm not an expert on either company, but that
mhm,
is the difference between BlackRock, which this report is by. So they're not in the real estate business per se, but they
okay,
have
okay.
some exposure here and there. But this is like the joke that everyone's like, BlackRock's buying up all the houses. BlackRock's not buying up a single house.
Yeah, yeah,
BlackRock may have invested in a company that bought some houses or like built some software to buy houses, but it's Blackstone that would be buying up the houses, and they're not even
okay.
buying up all the houses.
Yeah,
But
yeah.
anyway, so we've got this piece, 2024 private markets outlook. So they are looking at private markets, even though they're a public market asset manager.
Mhm.
Someone might say I got it all wrong, but I
Well,
don't
I
believe
think
so.
this is
Um,
I think this is interesting, and it kind of supported what was interesting to me about this report specifically is like BlackRock's not they're not in the echo chamber that you were talking about at an MHC, whether it's multifamily or
Precisely.
CRE.
Yeah.
So they're looking at a little bit from an outside in perspective, and you get like, well, okay, if this is what they're seeing, then I'd say it supports our thesis. And one of the things that they're focusing on is the strength of the CRE market and the opportunity that they see specifically in apartments. What do they say? Apartments in key suburban locations. So it's not like they're not drilling into multifamily with the intricacy that Marcus and Millichap may, but
Yeah.
they are seeing an opportunity, and it's these, if this is coming up on their radar, I think that's meaningful in a way that another positive spin that we get from an industry insider is not going to make that impact.
Yeah. Just further on that point, Matt,
Mhm.
you have to also look at it from outside of the echo chamber of the multifamily or even commercial real estate world of investors wanting to do deals. And this is getting back to the
Yeah.
equity, interest in the equity, and people ready to do deals. If you are an asset manager, you're a registered investment advisor, you're a wealth manager, something like that. You have clients who your job is to build and manage their portfolios, like portfolio construction, portfolio management, de-risking their portfolio based on the goals and objectives of your clients. Well, if you look at the portfolios of the wealthiest families, wealthiest individuals, wealth family offices, you look at what their allocations are. The one sector that's been growing over the last several decades are alternative investments, private investments, which are alternatives like not stocks, not bonds. And real estate is included in that. And real estate
Mhm.
often being the largest percentage. Other types of alternatives might be private equity, private credit, venture capital, angel investing, stuff like that. Like, oh, I'm going to invest. I might invest into an apartment building. I might invest into an oil and gas field or something like that. Things
Mhm.
that are uncorrelated. The idea is that it diversifies and de-risks your portfolio, and they're uncorrelated assets relative to stocks and bonds. It's like an evolution beyond the 60/40 stock and bond portfolio. Stocks are going to go up, or bonds will go
Yep.
down. Bonds will go up, stocks go down. So but this adds a whole other element to have a higher Sharpe ratio, which is essentially a metric used of how uncorrelated your portfolio is. And so getting to the point is these money managers are looking at the clients. They haven't done any real estate deals in a while,
Mhm.
probably not through 2023. Maybe they did some in 21, 22, and those haven't necessarily all worked out as well as they would have hoped. A lot of them have done development deals. Now they're getting back into it and they're looking at their client's portfolio and they're saying, well, the stock market actually is way up in 2023. Your portfolio is out of balance. Our clients, our collective clients, they are managing wealth for, they need an allocation into alternatives, specifically real estate. And then so there's a demand, not just like we want to do deals and from an almost an individual investor, but from this the big money, the big check writers are these wealth managers. And they're advising, especially reading at pieces like BlackRock and other pieces that are coming out, we need to ramp up our allocation to real estate, cash flowing real estate,
Yeah.
as a matter of continuing to diversify that portfolio. And so that's where I get into there's a mandate
Hmm.
to allocate into the sector, and alternatives in real estate have become more popular and much more of a keystone or a bedrock of
Yeah.
these portfolios for individuals, for family offices over the last decade or so than they ever have before. So the demand's never been higher for these types of investments. So that's just going to be one more piece driving. And now let's just get into the BlackRock piece, so I can stop rambling
Yeah.
and
No, I think that that's a really
take us
good point.
take us through it,
And
man.
well, no, it just to put a pin in that too is like the
Yeah,
changing nature of the investor population, or the widening of interest in commercial real estate and really multifamily specifically it's gonna have an effect on the market, and it's gonna mean it's gonna I think it will decrease volatility probably, but it may, it will definitely make it a more valuable asset class. It's not going to be. Times are different, and I think it's way different than it was in 2019 too. People are
yeah,
sticking around,
yeah,
but yeah, to go into this BlackRock piece, it does talk about apartments in key suburban locations, but really, their justification here is is demographics. So on page 21 of this PDF here, they talk about millennials and baby boomers. Millennials are entering their peak earning and consumption, and baby boomers are retiring. Well, the baby boomers they are correlated, I guess, with medical office and hospitality, destination retail, senior housing. This aging population, but millennials, they're saying, well, they want houses. They want houses in suburban locations, but that's going to drive up housing demand, and a lot of people will become renters as a result. This is what they said. This has made renting an increasingly attractive option and will likely be a tailwind for the residential renter section. This is this is something that we've seen coming, and it's interesting. They are charting this period between now and 2040. So that's a big span of time. That's much. This is not a 5-year plan. This is, we're talking about the next 15 years, and easily, 2-3 cycles of investments. So this will be interesting
yeah,
to watch. And I think that, by setting that time period so long, there it's almost reassuring to people, kind of like what you said. You want something that's uncorrelated, that's not going to kind of the ebb and flow with whatever happens. Well, these generational forces they were a long time coming, and they will be a long time going too. So it's a little bit of a nod to stability, I think, when they're trying to make this argument here.
yeah.
But
And
yeah,
a specific note that they made on, yeah, suburban housing, you said, and
mhm,
also single family rentals, but they're also saying just even also larger format apartment units,
yeah,
because as people have families, they still need the space to raise those families.
yeah.
Um,
And what you
yeah, no,
noted
that's
too.
very, very, very bullish and definitely a
Mhm,
secular kind of movement for housing and
yeah,
multifamily. And one thing that people miss a lot, and we've talked about this a lot multiple times before, Matt, is that you often don't see um, like apartments good, single family house is bad, single family
yeah,
house is good, apartment. Even though that it would, like, for example, in the pandemic in 2020 and 2020, really 2021, but second half of 2020 through 2021. When interest rates were zero and everyone's like, I'm going to go buy a house because I can get a 2% interest rate. Who wouldn't go out and buy a house? Everyone's going to buy a
yeah,
house. Well, what also happened? Everyone started going and renting apartments.
yeah,
And now what's happened now? Interest rates are so high, rents are lower. Seems like it'd be a good time to rent. It is. Demand's up. But you know what else has been doing really well? So somehow is single family home sales.
Yeah, yeah,
I mean, the volumes aren't up, but they're so super stable. The demand is still there. Household formation drives demand for all types of housing.
yeah.
Just something to keep in mind.
No, it's true. It's like the houses don't eat the lunch of apartments. Apartments aren't really eating the lunch of houses. It is yeah, housing is a category, and it is interesting. You know, I've seen a few people even talk about how, well, there may not be too much of an effect from even the high mortgage rates from people coming in to be renters. It's more like, and I think that that's actually fairly valid, and it's not in the middle of last year. I started seeing a lot more mention of how high mortgage costs, so home mortgages for people, they're going up so much that's going to increase renter demand. But we did not see renter demand explode like that, and I think that that's just
We saw a solid run, but we saw
yeah, yeah.
solid renter demand. We saw
No,
solid.
no,
I mean, we
it was solid
saw
renter demand, but
not
it
like
wasn't.
crazy trend, but
Yeah,
we saw like above. We saw above trend demand, like above the 20-year trend, according
yeah,
to I
yeah.
think Real Page.
It's
But
just like it didn't move
yeah, it
as
wasn't
much
crazy.
as yeah, yeah. So I think that housing as a category is much easier to track than to say that because something is happening in the single family market, it's necessarily going to have this effect in the, you know, it's going to have like an opposite
Yeah,
effect in the rental market.
I think you see. Yeah, they don't take each other's lunch. It's not a
Yeah,
zero sum. It's everyone's sharing lunch.
yeah, yeah,
Trading. Um, Very interesting. Recommend looking at that BlackRock piece if you're, especially for investor in other sectors. It's great. Just very kind of macro
yeah.
look at different asset classes. And again, if you're signing up for the Gray Report newsletter, you're going to be up to date. GrayCapitalLLC.com. And probably good to
And
mention, Matt, because we talked about the deal that we're working on.
mhm,
Haven't announced it yet. Should be under contract. I got a text message. Waiting for
yeah,
night. So hopefully we're under contract really soon. You're a credit investor, it's an exciting opportunity. I haven't been excited about this deal in a long time. And we have passed on over 100 deals, Matt, over the last like year and a half or so that haven't checked the boxes. This is the first one that not only has checked the boxes, but it's like it's jumping off the page is a great opportunity. So we're going to be making an announcement really soon. But if you go on to graycapitalllc.com, you can sign up for our investment portal. You click on new investor sign up for the portal. You'll be able to get all the information. The landing page also. Click on like our next deal, fill out some information. We'll get in touch with you. Set up a meeting. We can have a discussion, introduce ourselves, and see if it's a good, both ways, if it's a good fit. A really exciting opportunity. Just wanted to
great.
did a quick plug.
Oh, Gray Capital L. So
people dropped off.
I'll turn on the landing
Or
page.
graycap.net.
Graycap.net or graycapitalllc.com/new offering. Is that a good slug?
New dash offering.
Yeah.
Do we have the dash? This is just
new offering, all one word. I can change it now because I haven't turned on the website. All right, Gray Capital LLC/new offering, all one word. That's one of the landing pages that I'll have.
Okay, that's one of we'll have the dash too in case you
right.
like left
we'll just
the
catch them on both
podcast.
sides. That's right.
And then we'll have one with anyway, too much inside baseball. We'll have all kinds of options to get in touch with us, all kinds of links to click. There's gonna be a webinar and we'll also have like an investor tour day. You can come down, tour the property with us. A lot of fun. 2024 investment forecast, Matt. Multifamily investment forecast. Marcus and Millichap. This is the big kahuna right here. They put this out every year. John Chang's work is all over it. Who's a friend of the show, puts out a lot of great work. We can't go through all of it though, Matt. It's too long. It covers like every market. We just don't have time for that. So again, you can find it on Marcus Millichap's website. There's probably a link to it if you sign up for the newsletter. Beautiful cover. National investment forecast. Where would you like to begin, Matt? Because this is a lot to just sink our teeth into. We have to like cut it in half, and it's the best way to tackle this.
I think that maybe the best
presentation.
I'd like to start maybe around. Let's go to page 8 of the PDF here. So they have an economic outlook that is much more positive again than 2023. It talks about home price appreciation, employment is improving, and there are just some general.
Page 8.
Yeah, page 8,
Mhm.
but really, actually, let's go to page 9, because I really want to focus on the multifamily specifically. They continue to they it's a clear picture of the what they call sizable delivery pipeline. And what we have talked about too, it disguises the impact of improving demand as what they say 2024 may prove key year for housing. Demand is actually improving significantly, and you may not know it if you're only looking at rent growth, but it's definitely improving. And what I thought was interesting is some investors are looking beyond primary markets, and they're kind of they're expanding their interests, they're expanding their targets to outside markets like tertiary markets and secondary markets. And so I that I think is positive, and it's a strong sign that of investor demand and a growing realization that, like, well, if you can get returns in a market that is smaller than New York City, then why not? Um, and that could improve
Yep.
the viability of those markets anyway. So the share of trades in tertiary markets has gone from, I'm just looking at this graph here on page 11, it has increased fairly rapidly from like 33% in 2021 to like 40% now. I think that it almost runs counter to their other point that they make later. And this is, I've talked about this last week. They say the investor generation gap is increasingly salient. And I'm going to read this whole thing because I have my own response that I even, I went off last week and I'll continue to this week. They say investors who came of age since the great financial crisis have framed their strategies within the context of a 2.5% mean 10-year treasury rate and rent growth ranging above 5%. Comparatively, investors active in the 90s and early 2000s operated with an average 5.5% 10-year treasury and rent gains near 3.5%, which align closer to the anticipated investment climate going forward. This could strongly influence which investors will be most active this year. I've got a couple responses. One
Yeah.
response.
Well, yeah. Go for it.
One response is the makeup of an investment population is going to have an effect on that market in general. So if people are more competitive, then that market is going to be competitive because it's the people that set the prices. And secondly, it's all of these generational arguments, no matter if they're talking about avocado toast or if they're talking about the CRE market, they're all a little bit silly. It's not just the young
Yeah. What do you
people.
think generation? What was the generation that put the report together?
Yeah, I know. Well, that's true. Yeah, all the grunt work was done by the younger generation.
Yeah, I guess, yeah. There's probably
But they're
difference between
taking
who put
orders
some of
from
the
the older
slides
older
together and
generation
who.
and spinning. But my
That's
my
what I'm
big
saying.
my big point is a lot of times when they're saying, "Oh, the new generation, they love social media." No, everyone was on social media. They were talking, "Oh, the millennials, they love that Facebook." Remember that 15, 20 years ago? No, everyone went on Facebook. It's a lot of times generational arguments are made to describe the prevailing trends of a particular time period. And this time it was older folks and younger folks that were all bidding up prices in 2021. So it's not necessarily a generational argument. And I have a strong belief that people change according to their environment. If it's cold, I put a coat on. If the interest rates go up, I'm going to ask for lower prices. I don't think that it is that far of a leap to get past that kind of generational caricature. But
Yeah, and
that's
just
my
because you
rant.
remember 25 years ago what it was like, doesn't
Yeah,
mean that that's how you can immediately shift into operating, because
yeah,
a lot of other things have changed.
mhm,
And I do, yeah, we all have to acknowledge, obviously, there's cycles, and there's long debt cycles, and we easily could be in a higher interest rate environment for a period of time. But I also think that it's a fallacy to say, well, it's not gonna be like what you knew, it's gonna be like what I knew in
yeah.
the
I don't.
'90s.
Yeah, exactly.
Like, maybe it won't be any of those things
Hmm.
at all. Maybe it's a combination, but we've talked about this in the past, Matt, the sample
Yeah,
size of experience and people making big decisions based on trying to find analogs through their personal experience,
Mhm.
or it's almost always through personal experience. The rare exception are those who read through history, and the historical information we have on economics and markets is pretty coarse. It's not granular
Yeah,
information going back over 100 years ago. And you go back more than 200 years ago, you're not really getting good data or information. They didn't have like efficient market, they didn't have all the data.
yeah, yeah.
So like, we don't have very many good examples. And so I think, yeah, it's a little yeah, okay, yeah, it's not going to be 0% interest rates. One, not all millennials think that was like normal. Um,
Mhm.
and some millennials have a little bit of context. And I think it's an opportunity for some of the Gen X baby boomer generation to, flaunt their experience, which you have to respect
Yep,
experience
yep.
and knowledge, and they've been here before. And I think, but the idea that the millennial generation can't learn from that,
That's another thing too. It's like it's yeah,
can't
yeah,
adapt.
yeah.
I mean, And I mean, yeah, we weren't in a 5% treasury market, and we were in a pretty low interest rate environment, but it wasn't 0% for the last
Mhm.
decade or 2. I mean, the treasuries were in the 3% range or so. I don't know. Yeah, I think that we'll adapt, and everyone's got to adapt. And
Yeah,
reverting
I
back to, I just think, like, in that scenario, we have different dynamics going on. We had more built. We had a healthier housing supply at one point,
mhm.
and we've mentioned this. That's why you needed higher cap rates to get the higher cash flow to get your return on investment, because you weren't
Yeah,
getting as high of growth. You weren't getting as much. Yeah, your debt service was higher. Your rent growth rate wasn't as high. But also in the 90s, it's because, they made buying houses, very easy. Or
mhm.
to anybody, pretty much anyone can get a mortgage. Not that like, apartments were okay, but I think that did attenuate probably rent growth. Because if you look at, the houses that were built and people were buying houses in the mid 90s, it was crazy. Because the federal government got involved and allowed pretty much anybody to, get a mortgage. Um, that's not happening again either. So,
Yeah.
I mean, at least
Markets
not
are
yet.
different
I
too. I
could
mean,
see that maybe.
are they
It's
gonna be
just different
target
environment, different incentives.
Yeah, yeah. It's it I do, I value experience. I think that it's going to be worthwhile to talk to, your Gen X or your baby boomer executives in multifamily organizations. Say, oh, well, how did you navigate in a higher rate environment? That's nice. Talk to them and you'll learn something. But I also bet they were targeting different markets than they are today. And there are so many other things that were different then that that can't apply and won't apply now. Demographics are different.
Yeah.
There's so many
And we're not even
everything.
we haven't even mentioned technology, man.
Yeah.
Technology's changed a little bit. Like, not even like mention AI, but like, I mean, it's just, the world is a little bit different.
Hmm.
And again, I remember this. I talking to my dad. He would always tell me a story about talking to his father, and because he'll be like, you need to make the call. You need to go and meet the person in person. I'm like, well, how do I just give him a call, or send him an email? Don't send an email. Don't send an email. Give him a
Yeah.
call. Go meet in person. So, okay, I get it. And he told me, he said, his father told him. My dad was in sales, and my grandfather was in real estate sales also. And he said, you can't push a pencil through a telephone. Like, you can't see. It's so hard to close
It's
someone
true.
like on the phone, and to an extent. But then, so like, my dad, while very much respecting what my grandfather's saying, you know, at a later point, tells me, he's like, well, I kind of figured out that you could. Like, he started a business where they did a lot of sales over the phone,
Yeah.
and he was like, we figured out you could push a pencil through the
You could
telephone.
ask them to pick their own pencil up.
And because people get used to talking on
Yeah.
the phone and doing
Yeah.
business on the
Yeah.
phone. And
Hmm.
the same thing with, okay, well, yeah, through email is a weak form. I like, email is my least preferred method of communication, I think.
Yeah.
Like, I'd rather just talk or text. I don't know. I'm not a fan of email, especially today because of all the spam that you get. It's so I get so much email, it's hard to organize.
Hmm.
So if I miss your email, sorry. Um, but The ability to have, video conferences, meetings. The
Yeah.
fact that we can have a face to face that's better than a phone call. It's not the same as being in person.
Hmm.
But that changes the dynamics and how to do business and how technology can change how we operate. Um, but you still have to respect the fundamentals because I still think my grandfather was right
Yeah.
in that there's no replacement for getting together in person. There's no
Hmm.
replacement for spending time with someone, getting to know them.
Yeah.
So, technology, some things stay the same, some things are always changing, and we shouldn't be too quick to say, well, we just have to be humble about the future, right? Like,
Yeah. And
not, is it
and
the 90s? Is it the
and
aughts?
the young people and the old people, they're all changing at the same time. So they may not have the same change, but we're all going to be different. We all have different behaviors, and no one is stuck in their ways. And that applies to
Yeah,
investing as well as personal stuff. But, yeah,
yeah. Well, I just want to touch on a couple more things on this Marcus and
for
Millichap
sure.
piece, just from their like main
Hmm.
kind of overview. One, getting back to supply, obviously, the supply pressure is largely concentrated in the Sun Belt. I think this is just an interesting kind of chart, just highlighting what some of the markets are really seeing an oversupply, which ones are more moderate. But then I wanted to go back to this one of the first slides they had. I'm sorry, I'm sliding through
Mm,
here, and they put this up front, which I thought was interesting, before the table
yeah.
of contents. So that means whatever you want to take it this meaning. It's all about affordability. Homeowners hunker down. Households renting longer. Higher mortgage rates limit single family listings. And we're looking at sales slowdowns in the single family sales market, as high as 50% on the West Coast. They've seen, with overall price appreciation, 45% between 2020 and 2023. The Midwest, sales have slowed down 39%. Homes have appreciated 32%. The Northeast, sales are down 44, but homes have appreciated 43%. And in the South, similar to the West Coast, sales have slowed down 36%, but the prices have appreciated 46%. And then it's basically marking an affordability gap, between $0 and $750 or more, in which markets are more affordable and which markets are less affordable. And no surprise, a lot of the West Coast markets are much less affordable, and even a lot of the South Florida markets as well are really showing up in the very unaffordable, more than $5,000 gaps of affordability.
So what is this
And in this
affordability
chart,
gap? I'm trying to figure out what
I was
they
hoping you
mean.
could explain it, Matt. I was
Well,
hoping you could explain it.
I'm
I'm not sure. I'm not sure if it's gap between renting and owning a mortgage is what I'm assuming it is, between zero and
afford
700.
Oh, yeah, it is. Affordability gap is the difference between typical mortgage payment and average multifamily effective rent. So we're getting up there.
Got it. But look at this. I mean, this is the average across, the affordability gap for the nation. This chart right here in the bottom left, use affordability gap. I mean, back in 2012, 2013, I mean, that gap was it was razor thin. Great time to buy a home.
Wow.
I mean, it's been elevating, but I mean, since 2020, I mean, that's serious, and there's no end in sight of that.
Yeah. Yeah.
I mean, wages are growing, but they're not going to be growing by 46%. I'll tell you
Hmm.
that. And interest rates don't help. And it says here, housing market dynamics, high ownership costs underscores appeal of rentals. Now, again, people are still finding a way to buy homes.
Hmm.
Um, but a lot of folks just don't have the option to purchase a home, so they're looking at renting, whether that's a single family rental or an apartment.
And this is something I haven't mentioned in a few weeks, but the cloud of under over this, or at least just like there is an unspoken influence of remote working that has not gone away, and no one, I haven't seen it discussed that much outside of the specific office context, but I've got to think that that's part of the formula of home value now, as it was when it was new and talked about in 2020, is the idea that part of your home is going to be the place where you're working more. So maybe you need more bigger home, or maybe it's just more valuable for you. But that's
Yeah,
still a factor.
yeah.
And like,
Then,
yeah,
yeah,
yeah.
go ahead, Matt.
Just like even amidst like the stuff we're talking about demographics, and I think that that's a hugely important thing in household formation, but this change from to remote work is one of the, is one of the biggest changes that from a real estate perspective that that's ever happened. Like there are these huge empty office buildings. They're still return to work has not worked out like a lot of people have thought. And I was frankly a little bit surprised that that there's still the demand for office space is still relatively low.
When are people come back to the office? Or just some people you're saying no one's gonna some people it's not gonna happen.
It's not going to. I think that yeah, it's still persistent. And this is also looking at as a correlate. I haven't read any completely up to date stuff on the return to office and how much percentage are remote working, but I do know that office prospects every every the I'm sorry, this Moody's piece, and I think even in the BlackRock report, they're all talking about like, well, no, office has not improved like we wanted it to. Don't expect a miracle in 2024.
Well, I mean, yeah, I don't see why it would. I mean, unless it's just really lagging. I mean, some CEOs are making some big pushes to get people back into the office.
Yeah,
But I think it's such a good labor. Honestly, it's going to take the labor market
you're
declining.
right.
I
You're
think
right.
because people are like, I'll just get another job. I'll just apply for an all remote job. So there's no
Yeah,
confusion here.
yeah,
Because there's other companies who are like, hey, you see this advantage of like, hey, we need to hire for this role. Having a hard time finding. It's like, well, do they need to be here? Like, well, no, I guess they don't. It's like, well, let's just look across the country. Let's find the best person in the United States to do
yeah.
this job
Hmm.
and have them do it remotely. That to a company, it's like, well, if it's the right person, why the heck not? I mean, if you can get a better person, maybe more flexible in salary, bigger pool to look at, just because the best person may not live in a 30-mile radius to where um, your office is.
Hi, Spencer had to step out, so I'm going to step in here and close out this episode of the Gray Report with a great article from RealPage entitled Seven Takeaways from NMHC's Annual Meeting. We'll go through each one, give a little bit of details, then we will get going and get back to work. All right, so the first takeaway here is that optimism is back, and much different from this time last year. Obviously, we covered this last week when we talked about the CBRE Investor Intentions Survey. There's really so much more optimism. It's really an inverse of what we saw at the beginning of 2023, where most were holding back from the market. An equal amount now are ready to jump back in. One thing, and this is something that I noted earlier in this episode, was that greater clarity about pricing is another reason for optimism. Not just greater clarity about apartment fundamentals, interest rate trends, and expenses. The economy and the multifamily market, we know a whole lot more than we did, I think, at the beginning of 2023, and that's also kind of translating into a better view of the prices for CRE properties and for multifamily properties specifically. I also think that this clarity about pricing implies that prices are perhaps going to be less volatile and may not shift much lower than they are right now. The second point that they make here is that the bedrock strength of apartment fundamentals is strong. And yes, it's going to be overshadowed by multifamily supply this year. However, it's nevertheless, notably strong. And any other year that wasn't, a record decades high amount of apartment size expected, any other year apart from that, then we would really be really be crowing about the amount of multifamily demand. And I think that it is a great sign for a future, recovery in rent growth and normalization of the rent growth trends that were fairly stagnant and slightly negative in 2023. I think that there may be a slight surprise to the upside, perhaps, when it comes to rent growth. However, that's going to largely depend on the amount of apartment supply, which I will note right here, it's not fixed in stone. There are many different estimates of apartment supply. Some go as high as 600,000 to 700,000, which is ridiculous. But some, 400,000, 500,000, the amount of difference may determine, and especially when you're talking about specific markets, the ones that come online here or next year or the year after may have a big impact in what rent growth looks like, both, individually and nationally. Okay, so that's the second point. What about the third one? Heads on beds remains the strategy. Efficiency, 2023 was Facebook's year of efficiency, which I really like that they named that year. They got to name that year, but in the multifamily industry, it really rang true, because there was that stagnant rent growth, there was these expense challenges, and really, being as efficient as possible was such an important aspect of operations. And maintaining apartment occupancy has become a critical issue, if it wasn't a critical issue already. That's kind of pretty much the same as 2023. And RealPage notes that B and C class apartments are starting to feel the ripple effect of the new supply coming online. So Class A apartments come online, maybe other Class A apartments, because of that greater supply, those apartments get cheaper, and then Class B starts to, maybe rent growth starts to dip a little bit, and then finally maybe Class C starts to dip. It's not just like an anecdote or an example that I'm describing here. RealPage has really begun to record that in their data. So their fourth point here is about construction starts. They are really starting to plunge. The starts, not the finishes. This means substantially less supply by late 2025 and into 2026 and 2027, which also implies improved revenue growth. I think that this view of lower supply in later 2025 and through the next 3 years after that, that is playing a lot into investors' assessments of the current market. Yeah, they're looking past any difficulties, and they're seeing that such a great opportunity, and that may affect whatever kind of price floor we're approaching, or if we're already at a bottom for apartment valuations, that may very well be due to the assessments that, things are going to improve from an investor standpoint in the coming years. Okay, so the next takeaway after that is takeaway number 5 about expense growth. Expected to outpace revenue growth in a lot of markets in 2024, but the silver lining is that expense pressures are showing signs of mitigating. That's something that we have talked about here, and I mentioned this earlier, just a few minutes ago, and earlier, some of these takeaways could maybe be combined. Maybe we get 5, but that's nothing. That's all right. I'll give them 7. Expense growth is not expected to get much weaker, but man, that's a long tail for expense growth. Inflation really peaked in 2022, and 2023 was really when it began to rear its ugly head, so to speak, in the multifamily market, because of the contracts and the way that expenses were a pressure on vendors. Maybe in 2022, they carried forward when contracts were renewed to multifamily operators in 23. That's when the operators' expenses went up, and that really hasn't stopped in full force for 2024. So there's still going to be, whether it's insurance or utilities or what have you, there still may be some expenses that require this emphasis, like I said earlier, with heads on beds or occupancy, and really making sure that your revenue growth is high. And it may mean a little bit less risks to take from an operator standpoint, and making sure that you're maintaining that occupancy, and that may or may not have an effect on rent growth. We'll see, but I think that it's another reminder that it's work to operate in these apartment properties. And if you don't have a good property management team, and I will plug the excellent folks at Gray Residential right now, but if you don't have that team in place, then you're going to be struggling. And if you don't have a perspective on what a good contract looks like, on how much it costs to do things like, let's say, landscaping or apartment. Maybe you're getting your parking lot redone. If you don't have a good idea of what that costs, and really know how much, and maybe you want to spend a lot because the quality is worth it, Well, if you don't have a perspective on those kinds of decisions, then 2024 may be difficult for you. But then again, it may be difficult for you no matter what. So it's always valuable to have a good sense of the prices going into things, where how much things are way off base, and maybe there are certain expenses that you hold off on in certain years or certain times of year, and waiting till prices come down. However, that's going to be an answer for the experts at Gray Residential more than me. I just know to respect the expertise of a really strong property management team. Now, their sixth takeaway is about values. Now, I've kind of noted this. Values for apartment properties could be bottoming, and cap rates settling in the mid 5% range. Some think lower. Everyone's targeting 5 or 6% plus range for their cap rates, but there are few sellers at those prices for like institutional class A and B apartments. This is something that I remember Spencer mentioning earlier. We may not see the spectacular deals for apartments that are, bright and shiny new, as much as a huge glut of class A new apartments are coming online. Those are probably not going to be the ones where people are going to find deals as deals emerge in 2024. The real opportunities may be in maybe B, B, C class apartments, rather than, again, the bright and shiny new A class. Now, that could mean a value add strategy, and I think that's increasingly, as expenses improves and the price for renovating gets a little bit better and makes more sense, then those value add strategies may become more prevalent. That is to say, if they're not already quite prevalent already. Okay, so the seventh takeaway, just to close this out here, is that investors are increasingly resigned to see relatively little distress among institutional grade assets hit the market in 2024. That parenthetical reference, institutional class assets, the class A's, and maybe the higher class B plus assets, the ones that are bright, shiny, they got, they're fully occupied, they've got the nice amenities, there doesn't need to be a whole lot of work on them. It doesn't need necessarily, it doesn't lend itself maybe to a value add. They are just, solid, beautiful apartments. Those probably aren't going to be the ones that the bank's like, ooh, I don't know, I'm going to have to ask you to pay up now. I wonder if the banks would be more willing to allow those extensions and those workouts for nicer apartment properties. At least that seems to be the implication in this Real Page article. However, this is something that we've noted in the Gray Report and in other research from Gray Capital, is that the issue of multifamily loan maturities or distress, it may not be a crisis or a catastrophe that defines the market, but it will be a factor that determines, a price. Maybe the prices will be a little bit low because even if they're extending and pretending, those extensions and those workouts will still make it a little less attractive to hold on to those properties at a higher interest rate than maybe it will to sell. I'm not saying that sellers will be 100% aware of the current buying selling gap, and they're really going to rush please buyers. No, they're still going to want top dollar as much as they want, but it may change the calculation, and I don't think that it is worth dismissing it, at least as a factor of the apartment market. And that's all the takeaways from this NMHC coverage from Real Page. I'm sorry. And that is it for this week's episode of the Gray Report. Thanks for sticking in with me as I closed out this episode. I think it was an excellent article, and I'm glad that I was here to finish things up. If you are still interested, I would suggest that you go ahead and subscribe to the Gray Report. If you haven't already, subscribe, follow, connect, do whatever you can so that we're able to share our information, research, and analysis with you every week, sometimes multiple times a week. If you subscribe to the Gray Report newsletter at www.graycapitalllc.com/newsletter, we will be right there with you Thursdays and Sundays with a bi-weekly report of all the greatest and latest and most important and valuable. We got news articles, we have research reports, we have some of our own analysis in there, but not too much because we like to keep it concise. But again, if you are still interested, please stay tuned, because we've got lots of great, really exciting announcements coming from Gray Capital specifically. So like we said earlier, watch this space. We're really excited to share with you some of this information that we have up, and we'll see you next Gray Report. Thanks.